let's look at a bond that has sold for less than what the market rate is. It's going to be selling at a discount. So on January 1st, 2010, a $500,000 8% bond, the 8% is the coupon rate, bond sold at 98. It has a 10-year maturity, and the interest is going to be paid on a semi-annual basis, meaning 2 times a year. Okay? So the first entry that we're going to make whenever we sell the bonds on 1/1 is going to be cash as a debit. Remember, we're selling the bonds for cash. Cash is an asset. Assets increase on the debit side. I'm not going to plug in the amounts just yet. We're going to wait. We have a new account that's a contra account to our bonds payable account. It's called the discount on bonds payable. I'm abbreviating so we have enough space. And then we've got our bonds payable. Okay? Our bonds payable is always going to be listed at the face value. The face value of these bonds is $500,000. Okay, so we're crediting bonds payable. Bonds payable is a liability. Liability is increased on the credit side for the full amount of $500,000. The reason I knew it was a discount is because they sold for less than 100%. So I'm going to take $500,000 times 98% and calculate how much money it is that we're going to receive whenever we sell these discounted bonds. 500,000 times 98% is going to be $490,000. That's how much investors are willing to pay us for these discounted rates, or these discounted bonds. So our cash is going to be debited for $490,000. The difference is going to be between these two. Remember, our debits always have to equal the total of our credits. So we've got $500,000 on the credit side and $490,000 on the debit side. Okay? So we're going to put the $10,000 here for the discount on bonds payable. We're going to have to amortize this over the life of the loan, which is the 10 years, in order to account for the discount, and it's going to be used whenever we do the semi-annual interest payments. Okay? So for our first semi-annual interest payment, we are going to do the interest account. We're going to reduce the discount on bonds payable, so we're going to credit it. And then we're also going to credit the cash account because we're paying them that interest. Cash is leaving our pocket. Assets decrease on the credit side. Okay? Remember what we talked about. The face value of the note times the coupon rate is going to give our annual interest rate. This is a semi-annual. So we're going to take 500,000 times 8% divided by 2, or we can take 500,000 times 4%. That's going to give us $20,000, and that's going to be how much we are actually paying. We're paying $20,000. For our discount on the bonds payable, we're going to amortize this $10,000 over the life of the loan. How many periods would there be if we paid semi-annual interest on a 10-year maturity? We're going to take all 10 of those years and pay it 2 times a year, times 2, so that's going to give us 20 periods. Okay? So we're going to amortize $10,000 over 10 periods, or 20 periods, I'm sorry. So $500 is going to be how much we amortize the discount on bonds payable. Okay, so now we have 2 credits, $20,000 and $500. Our debit to interest expense is going to be the sum of those two, since we want the total of our debits to equal the total of our credits. Okay, So this is what a typical entry would look like if we were doing straight line amortization on the discount for a bond problem.